It is hump day, 30 minutes until the start of the cash trade. I'm Matt Miller.
And Fed Day, I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, a divided Fed is set to deliver another rate cut today, but the big question is what happens next?
And Oracle's earnings may set the tone for the final few weeks of the year as those AI bubble fears still linger.
Plus, SpaceX plans to launch the largest IPO of all time, and it could unleash a wave of listings in the new year.
Matt, I want to give a check on Meta shares this morning. Let's go over here and take a look because I think we might be getting some news from them. Yes, we are indeed. Shares are now down 0.73%. Meta's Mark Zuckerberg, he has directed his team to pivot away from open source AI. According to news, again, we were just breaking that moments ago. Zuckerberg apparently getting involved in the day-to-day work of Meta's AI plans. They're developing a new model codenamed Avocado that it may charge users for access. Matt, we're going to talk more about Ed Ludlow for this, but it just shows maybe some divide, a little bit of discontent, at least when it comes to Meta and their AI.
All right, well, interesting. From llama to avocado. Stocks like EchoStar and Rocket Labs are climbing after Bloomberg learned, and we're going to talk to Ed about this as well. SpaceX is moving ahead with plans for an IPO targeting a $1.5 trillion valuation. It would raise more than $30 billion to fund projects including space-based data centers, and that would beat out the Saudi Aramco IPO, which remember was $29 billion raised.
Yeah, it would be huge. Let's get to both those stories. Joining us, as we said, is Bloomberg Tech co-host Ed Ludlow, joining from San Francisco. Ed, a very busy past 12 hours. Just starting on this Meta story, because the story with Meta typically is they hire, ex-AI expert from Apple. They've hired up so much talent. You'd think that they have an insane bench and that things are going smoothly. Does this suggest that things are not going so smoothly with Meta and their development of their AI offering?
Well, in the first instance, when the story hit, there was a kind of strange algo spike and then drop in the shares, but we're now down 1.5%. So it's difficult to interpret the market's read on Meta shifting to closed model. What Kurt Wagner and Riley Griffin, our colleagues, are reporting is a lot of detail about the specific model, Avocado, which had originally been planned as an open model, and according to sources, may launch as a closed model. It's interesting in the technology development side because what Meta did was take models from others, including Alibaba's Gwen model, for example, and use that existing work to distill and prepare their own model. That's something that Frontier Labs do all the time. But it's not new, the idea that Meta might go from a very clear open source approach to closed. Mark Zuckerberg talked about it in July's earnings call, basically saying at some point in an open source world, the models are so big and the resource requirements are so high, what's the point? Academics don't have the funds to work at that scale. And really, it's only relevant to private industry if you're working on a model that has that level of parameter and requirement.
All right, that's a fascinating story we're going to continue to dive into. I want to ask about the SpaceX story. Your name was on the byline yesterday, and it looks like we could have a $1.5 trillion valuation. And in my mind, I'm always adding up Elon Musk's assets to see if he ever gets to $8.5 trillion in total.
Yeah, my understanding is that this is very much underway. The work is being done by SpaceX's management, by SpaceX's board. The target is the middle of 2026. Things always change, right? So the valuation, where we settle, we'll find out. It's interesting. From the amount of money they want to raise perspective, this could be the biggest of all time. And what sources tell me is it's going to be far north of $30 billion, which is interesting because Musk has really pushed back recently on SpaceX's capital needs. But what sources explain to me is that SpaceX has this vision where humankind is multiplanetary. Musk has talked about this, the role of Starship in getting us to Mars. But the next big market for them is space-based data center. Literally taking AI GPUs, putting them in a satellite form factor, putting them in constellation, running workloads in space, largely inference. That's going to take a lot of money because SpaceX would need to buy the chips. And I think that that's the story here. But who doesn't love the story? Potential biggest IPO of all time.
No, it's a fantastic story. And by the way, do you follow my logic on the $8 trillion? Like Tesla's worth 1.5. You know, SpaceX is going to be 1.5. You start to fold these things together, and eventually he could get to this milestone that would give him a $1 trillion payout.
Just really quick, can I ask your audience if they know the answer, like message me on socials or whatever, but as far as I can tell, in SEC rules, any other rule, there's no rule that precludes Elon Musk being the CEO of two more than $1 trillion market value companies. How do they work together? Interesting, like we've talked a lot about Elon Inc. You know, if they're going to do space-based data center, isn't that highly analogous with XAI, a private company? I'm trying to work that out. That's kind of the next frontier.
All right, fascinating stuff. This is why we look forward to your show every day at 11. Ed, thanks so much for joining us. Bloomberg Tech's Ed Ludlow there. We also have our eyes on Oracle and Adobe. Both companies will be reporting earnings after the bell today. And of course, Oracle is under the spotlight. It's got to ease investor anxiety about a potential bubble in the AI spend as Adobe fights increased competition. Let's discuss with Anurag Rana, senior tech analyst for Bloomberg Intelligence. So first off, Anurag, with Oracle, what do you need to see from them?
I think they need to come out and talk about where is the money coming from and how are they going to fund this massive RPO that's on their balance sheet, because that's really what the biggest uncertainty right now is. How's this big OpenAI order going to flow into sales down the road?
Anurag, I mean, just how much is at stake in terms of the narrative of debt building up, especially for Oracle with CDS spreads widening up? How much is at stake when it comes to that and the ability for markets to not push this? What we're looking at is CDS spreads even higher.
Yeah, when you look at Oracle, they've given a very large number of sales target of about $225 billion by FY30. That a large portion of that is going to come from those OpenAI workloads or the AI workloads. So everything rotates around how is this consortium going to fund the expansion, create new data center, and how is OpenAI going to use those, you could say, the big promises that they have made into sales for Oracle? I think that's all we care about at this point. Everything else, to be honest, is on the backseat.
All right, and of course, we'll see Adobe as well. I want to pivot, though, to an NVIDIA story with you, Anurag, because we've been talking with Mandeep, your colleague in the tech coverage at Bloomberg Intelligence, about whether NVIDIA can sell chips into China, whether the Chinese will buy them. It seems that Beijing is trying to dissuade private companies from doing that. But it turns out that Deepseek is planning on using NVIDIA chips in its next model. So they clearly want to use this product and have some access to it.
See, when it comes to training, I mean, I don't think there is a chip out there that's better than what NVIDIA is offering. So if you are trying to compete for the best frontier model out there, I mean, you will be using those chips one way or the other. Whether you publicize or not, that's different. Very few companies have the access to Google TPUs, for example. So NVIDIA is the normal choice for them, especially for training. For inference down the road, we could argue that, you could use other semiconductor devices. But, for now, we really need NVIDIA for training reasons.
Yeah, a really interesting story from the information. Anurag, thank you so much for joining us. Anurag Rana of Bloomberg Intelligence, who, by the way, is going to be back in the next hour. Anurag and the team at Bloomberg Intelligence did a fascinating story. It is the biggest C-suite survey that reveals heightened awareness of AI disruption risks. So stick around for that conversation. First, though, the Fed is expected to deliver another rate cut today. The surprise may come to how dovish or how hawkish their guidance is. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, there are some analysts out there saying that we might have as much as half of the committee possibly opposing whatever outcome we get from the Fed decision. Just how much of a divided Fed are we going to be getting today?
Well, we're going to get a divided Fed. How much they want to publicize that is kind of the question, Dani. I mean, with all this tech news going on, the Fed is going to have to really perform today to try to get in the headlines, and I think they might do it. We did have a little bit of news just a short time ago. The employment cost index for the third quarter came out, and it showed wage growth is slowing, 3.5% on an annual basis for the quarter, and that just suggests that the affordability problems people are talking about are out there, but it also means that it is not an inflation issue. So we shall see if that figures into their decision. Now, as you mentioned, we are expecting what is called a hawkish cut. They'll cut by 25 basis points, but in theory signal that they are not going to be cutting anytime soon after that while they wait to see what happens with the economy. And we are expecting multiple dissents. Remember, last time we had two, one on each side. This time there could be as many as 3 or 4. We haven't had 3 dissents since 2019. We haven't had 4 since 1992. So that might get us on the front page. Dot drama. The market sees 2 cuts in 2026. How many does the Fed see? And how many say they did not see another cut this time, even if they weren't a voter? That's going to get a lot of attention out there. Also, the unemployment and inflation outlook that we get from them. So look forward to seeing a lot of perhaps division. Of course, the minutes are going to be very interesting, but this is definitely a divided Fed, even if the markets are pretty certain about what the outcome is going to be.
All right, Mike, we look forward to the meeting, to the outcome, to you on Bloomberg Television this afternoon. Michael McKee in Washington, D.C. Don't miss our special coverage of the Fed decision that kicks off at 1:30 p.m. New York time right here on Bloomberg Television and on Bloomberg Radio.
All right, a quick check on markets this morning. Sorry, Matt.
No, I appreciate it.
You paused. I thought maybe I'd jump in. Okay, S&P 500 and NASDAQ futures are still negative this morning after a day where we kind of did absolutely nothing yesterday. We basically did nothing the day before. Small caps did outperform. They underperformed today. Matt, it has been bond yields under pressure, moving higher. That's been pressuring stocks, but maybe going a whole lot of nowhere today just until that Fed decision.
Yeah, right now at 4.18, almost to 4.19 on the 10-year yield, which I've found fascinating ever since Ed Harrison's story out on Monday that global yields were going to drag interest rates up here in the U.S. as well. Let's get a look at some of the other movers on our radar. Single stock stories that you don't want to miss. People in the control room truly concerned about Cracker Barrel.
You're not?
It expects sales to fall faster than previously had been forecast. It does plan to cut costs by up to $25 million to offset those losses. But don't forget, in case you're skipping it because of the logo, they went back.
They did go back.
They went back.
How much of this is people being like, oh, I'm mad at them for the logo thing, so I'm not going to go, versus people just aren't going to Cracker Barrel?
Still just a delightful place to bring the family.
It is an old country store, and you gotta love it. By the way, GE Vernovia, a completely different company. It's surging. It's doubled its dividend. It's boosted buybacks at $10 billion. It's a firm part of its 2025 guidance because they do energy, and AI demand means we need more energy.
Yeah, a lot of dividend news yesterday. MasterCard also $15 billion, buyback. Chewy exceeded the high end of net sales guidance as it retains customers through pet supply subscriptions. You can see Chewy shares up almost 7% in the pre-market.
Coming up, we're going to talk more about AI. It's expected to drive, at least for now, a hiring boom on Wall Street as investment bankers build out deal data sets. We're going to have more on that coming up. And in the next hour, we're going to talk about AI, private credit, and more. We have an exclusive interview with Blue Owl co-president Craig Packer. Don't miss that and more on Bloomberg Open Interest.
Let's get out of high interest. Look at what's making headlines around the world. The U.S. is proposing that all visa-exempt visitors from nations like Australia, Germany, Japan, and the U.K. submit 5 years of social media history before entering this country. Customs and Border Protection says the data would become mandatory through the online travel authorization system. It comes as the Trump administration tightens entry rules and reviews past approvals. Eileen Higgins has won Miami's mayoral runoff, defeating Trump-backed Emilio Gonzalez and becoming the city's first woman and first Democratic mayor in nearly 30 years. Her decisive 18-point victory caps recent Democratic gains nationwide. The win is a shot in the arm for Democrats in Miami, who have been losing their grip on South Florida, previously a Democratic stronghold that previously a Republican stronghold. Obviously, it's South Florida that Trump won by 11 points last year. Investment banks are mining years of deal data to sharpen their AI tools and win more mandates. Moelis and Houlihan-Lokey say richer data sets help them advise clients faster and better, and in some cases even create new data products. Executives insist AI won't replace junior bankers, but it will speed up deals and boost productivity across the industry.
Let's get more on that story, Matt. Joining us now is the reporter behind it is Bloomberg banking reporter Todd Gillespie. And Todd, the reason this story, I think, captured a lot of people's attention is it feels like a little bit of the opposite of the narrative. The narrative had been that AI is replacing bankers, it's going to cost jobs. This is saying, maybe at least for now, it's additive.
Yeah, well, we're certainly at this stage, Dani, where investment banks are sort of trying to calibrate, trying to understand exactly where the productivity savings are coming from the AI tech that they're doing. Remember, this is a heavily relationship-based industry, always has been. It's about the relationships with bankers and their clients, sometimes that last decades, golfing, family, you know, all this kind of thing. That's really the meat of what the industry is about. So for these people to now sort of try to understand efficiency savings and implementing technology that they've never really had to think about that deeply, maybe, apart from the old Excel spreadsheet and modeling, you know, thinking about what that really does to the composition of the bankers that they have, the relationships that these bankers might bring in, balancing all of these different considerations. Some of these banks are now sort of, they're sort of in that phase where they're thinking about what is this going to do to our headcount. Some of them further down the line admit maybe this may still change. I think it's maybe still too early to say definitively whether some of these investment banks might start hiring fewer junior analysts. Maybe these analysts might just be emboldened to do more of the relationship type work.
Is it too early to say that? I was having dad's drinks last weekend in Scarsdale with a bunch of lawyers and consultants and investment bankers, and they all said that they don't really have any reason to hire a freshman class. Like, AI does almost everything that these kids would be doing.
Yeah, well, then that raises the question, Matt, like, what happens when, I mean, I'm sure you're a long way from that and your friends are a long way from that, but what happens when they retire? To have senior bankers, you need junior bankers coming through the pipeline. No, that's
exactly the worry. That's exactly the concern.
And so I think you sort of need, to some degree, to have these people who are at least trained on these tools. And I think, you know, Blair Efron said this a little while ago, but, you know, he was sort of saying if he was advising someone to go and study at university now, actually going and studying a liberal arts degree or thinking about critical thinking skills is just as important, if not more important, in the AI world than understanding the tech. As long as you can use these tools, actually the edge that you gain in using these relationships and knowing how to build these relationships and capitalizing on that is just as important as it ever has been, if not more important.
Yeah, and you feel bad for everyone that was like, go get a computer science degree, because that's going to be the thing, but now coding can just be done by AI. Separately, okay, hiring is one thing.
All software can be done by AI.
All software. We're going to have this conversation later on, Matt doing a deep tease for the show. Okay, but at the same time, what you're describing is hiring people to bring in AI expertise, developing these different models. That costs money. How much of that is related to the JP Morgan warning we got yesterday from Marion Lake that they are going to be spending and having higher costs than they previously assumed?
Yeah, I mean, it's certainly one thing that she did raise in her long list of causes for a rise in expenses that sent their shares down about 4% yesterday. I mean, I was at the conference myself. A lot of the investors and analysts there were quite shocked, thinking about the read across to the rest of the industry, how much of this higher spend is going to be affecting, it's going to be seen at these other banks as well. So far, we haven't quite seen that read through. JP Morgan did also list off, higher compensation for advisors, branch building exercises, and AI as well. So it's kind of unclear at the moment exactly where that cost is going to be allocated. But it is reminiscent of an episode a few years ago of when JP Morgan did also come out with higher than expected guidance and then had to go and pacify investors through an Investor Day by breaking it all down in a minutiae way.
I was just looking to see what your major was when you went to Harvard and Cambridge.
Thanks, man.
Yeah.
Never heard of them.
Political science?
Yeah. So yeah.
Dani, your major?
Journalism.
At UVA?
At UVA, yeah.
All right. Excellent. Todd, international business at Antioch College, the now defunct.
Well, at least you can do math.
Antioch College. Todd Gillespie joining us from the BN side and Harvard and Cambridge. Coming up, Allspring's Anne Miletti shares her top 6 ideas for 2026. This is Bloomberg Open Interest.
Given this sort of extraordinary time that we're in, where earnings are going to be good, the economy's humming along, even with the questions around labor. But the point is both monetary and fiscal stimulus really do have the potential. We've said there's a 30% chance that you get a full-on bubble next year, which we define as 9,000 in the S&P 500, which I think is also why, on balance, the Fed is trying to remind everyone of the dual mandate in general.
Julian Emanuel from Evercore, who, by the way, his year-end price target is 7,750, but says we could go to 9,000 in the case of an AI bubble. Let's bring in Allspring's head of equity investment, Ann Miletti. Ann, wonderful to see you this morning. I mean, 30% odds that we get, that seems pretty high. What do you think are the odds that we get a real bubble building in some of these AI names, which already have very lofty valuations?
Yeah, I mean, I kind of liken it to the fact that we've moved from still to sparkling water. So lots of little tiny bubbles, whether any of them emerge as a bigger bubble that causes a major problem has yet to be seen. And I know the last time I was on, we talked a little bit about the internet cycle and working through that as an analyst myself, as a media analyst. And it was like, are we in 98 or 99, or are we closer to 2000? And I think that's kind of what the market's trying to determine right now with AI. I mean, the innovation cycle is real, but as you go through the CapEx build, it's likely that there's a lot of money being spent that probably doesn't need to be spent.
Yeah, it seems like it's a question of when, but not if, right? There's always a bubble of some sort when you get this level of disruption in technology.
Yes.
All right, Ann, you're going to stick with us. We got to pay the bills first, so we're going to go to break. But after that, the opening bell coming up as we look at futures that are doing a whole lot of nothing. Once again, what's going to break us out of this cycle? Well, maybe it happens today. Remember, it's Fed Day, and we got the opening bell, the cash trade on the other side of this break. This is Bloomberg Open Interest. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller, and it's Fed Day. So typically what we see on Fed Day is not a lot of movement. Essentially, traders turn off the algorithms and wait until they get a human to parse through the statement. We're not seeing a lot of movement right now in futures. They are to the downside, and we haven't had a lift for a few sessions now. So we'll see what happens at 1:30 p.m. today. We air our special The Fed Decides. Tom Keene coming back to TV is always an amazing thing to see. So definitely you're going to want to watch this. The Magnum company ringing the opening bell down at the New York Stock Exchange after their IPO, a spin out.
Cowbells?
That we saw.
That normal? That's not normal, right?
Oh, you need more cowbell. I think you need more cow.
It's the only cure.
You always need more cowbell. And this guy has a tie-dye shirt on, which I love, you know. What an interesting story, and MICC, the ticker there, and it was an $8 billion market cap. So wearing leather jackets down at the NASDAQ Stock Exchange with a man bun, the CEO of Atlassian, which, believe it or not, Dani is, I mean, you know if you watch the show, Dani is the Formula One addict. So
I was going to say, the reason I know who they are is because they're the title sponsor for Williams. Like, they're Williams, Atlassian, Racing, or whatever. I don't know much about the company. I think they do data things, but they sponsor Williams, which is very,
very important,
very important.
To Dani and 600 million people around the world who watch F1.
I'm not alone. By the way, Matt, I want to show you what Meta shares are doing here at the Open. They're not down as much as they were right around 30 minutes ago, because we had that breaking story that Mark Zuckerberg has directed his team to pivot away from open source AI, according to our very own Bloomberg sources. And Zuckerberg is also getting involved in the day-to-day work plans of their AI. The firm is developing a new model codenamed Avocado that it may charge users in order to access. And so that's no longer Llama. Now it's Avocado, and they're trying to make money off of it, Matt.
All right, very interesting story, and honestly, the competition builds. You know, do you pay $20 a month to ChatGPT? Do you pay $20 a month to Gemini 3? Do you pay $20 a month now for an Avocado, which is much cheaper than your typical monthly avocado bill.
You're so right, Matt.
Dani. All right, Oracle and Adobe reporting earnings after the bell. Oracle shares have plunged by a third since hitting an all-time high in September because investors are concerned about debt, because investors are concerned about AI spending. Adobe has been struggling to keep up with competitors in the AI age, and I guess a concern there is software is going to get eaten, basically, by AI, and you still won't be able to cancel your Adobe Acrobat subscription. Let's bring back Allspring's head of equity investments, Anne Miletti. And what do you think about this idea that AI can do everything software can do? I mean, Howard Marks was out yesterday with a newsletter, not talking specifically about software companies, but talking about their employees and saying, you no longer need coders.
Yeah. Well, I think the new software environment is going to look different than it has in the past. And so while it probably doesn't destroy every software company out there, it changes the trajectory and the look of what the industry looks like going forward. And so I think it's going to be fascinating to see, but AI is changing a lot, and not just for technology or software.
I was going to say, you look at a company like CRM, for example, that's the ticker of Salesforce. I mean, the thing has gotten so beaten up. It's down 22% this year. The S&P is up 16%. Matt and I are going to be speaking with Craig Packer of Blue Owl in a little bit in the next hour, who about 30% of their funds, or more than that, is concentrated in software. For a client who has a big concentration in software, is this a scary time? I mean, would you be recommending taking positions, selling positions? What would you do with the sector right now?
Well, again, I think our teams are not as excited about this sector right now. But as an investor, what you have to really watch for first, I think, is pricing. And, you know, as a consumer, as a company that consumes a lot of software, you pay a lot. You were talking about, you know, from a retail perspective, what consumers pay, but businesses pay a lot for the software. And, you know, I think the first thing we'll do is see compression in pricing as companies figure out what they can do on their own with AI. And again, then you'll start to see the changing hands of, like, what can we do with AI? What do we need new software tools for?
So I wonder how it changes your macro view, right? As you know, productivity increases. Does that mean that we add a point to GDP, as you know, some Fed governors have suggested, or does it mean that, you know, unemployment goes to 5%? Yeah,
you know, it's interesting because I do think the first phase of this is, you know, kind of we call it AI 2.0. It's really, it broadens out the economy into, it broadens out into other sectors within the economy. And at first, it can create more opportunity, more productivity, higher margins in many cases. But it will definitely have effect on winners and losers. And again, I think that's where active management really can play a role, because company fundamentals and where companies are investing for the future and their management teams all play a role in what's going on there. And so that's where our investment teams are paying a lot of attention to.
By the way, one of the other big exciting narratives to end the year that's really had some juice to it is media consolidation with Warner Brothers Discovery. It's the kind of thing that would make for a really good book. It feels like Barbarians at the Gate 2.0. Does it say something to you about animal spirits? And again, you know, much of your career was as a media analyst. Does it say something about wider market conditions? The fact that this battle is even happening.
Yeah, and look, I'm fascinated by the battle given my former history, but it is one of our 26 themes, right? Broadening out of the markets into many different sectors. M&A as a pickup. We certainly have seen M&A pick up the back half of 25. I think we're going to see more of that. The market conditions are more conducive, lighter regulatory conditions for the most part, lower rates than we had last year. We have private equity that has a lot of, you know, companies that they need to get out into the public markets, and, you know, companies that I think are ripe for consolidation. And so that will continue. I think that actually plays into our third theme, which is, you know, small and mid-cap companies can still do well based on some of those macro factors, but they're also kind of great targets for M&A.
I got to ask, you know, as a former media analyst, when you look at the competitive landscape, do you look at, you know, streamer versus streamer versus streamer? And where does, you know, YouTube And by the way, I'm only doing this because the tiles on my Apple TV are the streaming services and then YouTube. But more and more I'm clicking down to YouTube rather than clicking on Amazon Prime or Apple TV to watch stuff.
Well, I know you have two little ones.
True.
And,
so Disney is obviously
well,
an app that we're on all the time.
But I have 3 grandchildren too, and YouTube is still like a favorite.
I don't believe you.
Theirs.
I don't believe you, Ann.
Thank you. I hope it's about the grandchildren. But the YouTube platform is, more and more in future generations becoming more important than it was for my generation. Like, I don't spend a ton of time on YouTube other than watching Bloomberg in the morning. But I watch what not only my kids are doing, but my grandkids are doing too, to say, all right, what does future state look like? So I think you're right. The landscape has changed versus when I was following media stocks.
Such an interesting time. And thank you so much for joining. You are truly one of the best. That is Allsprings and Miletti. I want to get a check on your equity market right now. As Matt pointed out at the open 8 minutes ago, going a whole lot of nowhere. We are slightly lower. Breadth is pretty even between the upside and the downside. What is getting us there? When it comes to the upside, Amazon's doing really well. GE Vernova, they had earnings that were incredibly good. Dividends, buybacks, upgrades to their future outlook. In fact, they said that the backlog for electrification will double by 2028. You guessed it, it's an AI data center story. Looking at the other side, Microsoft, I've actually been trying to look for a reason for why this is so weak today. I don't necessarily see a clear one. It's down 2.5% today. Meta is doing poorly. Again, we broke that news, that Bloomberg scoop at the top of the hour, that they're rethinking some of their AI offerings. Intel is falling. This is lawsuit related. Those shares a little bit weaker in today's session. Looking at some of the sectors this morning, you can see a lot of those tech players were down. So you can see that. And the worst performing is Infotech, down 0.6%. Communications, same kind of companies too. At the top, you got industrials, consumer discretionary, real estate. But Matt, how much of this is going to change after 2 p.m.? Probably a lot of it, I guess. It seems like it's going to be a spicy Fed decision. So at least that's how things stand at about 9:40 a.m. this morning.
I got to tell you, I'm pretty interested in GE Vernova, and not just because of the dividend and the buyback story, but a few months ago, I had a viewer write in and say, dude, you guys have to look at the backlog for these gas turbines.
It's huge.
It's years. And obviously, they are, GE Vernova, the world's largest manufacturer and supplier of gas turbine technology. So it's just a massive piece of this data center build-out.
But it's going to get worse, right? They said in their earnings that the current backlog, which you said is going to be years for them, is going to double by 2028. So it's not getting better. It's getting even worse.
Yes. Charles, if you're watching, thank you very much for the note. And anyone else, feel free to write in with tips. Coming up, it turns out that the Cracker Barrel logo fiasco didn't help sales last quarter. Details on the state of the, is it a fast casual? It's not so fast.
It's a restaurant.
It's pretty casual, but it's not super fast. But it's delicious. We'll talk about Cracker Barrel, just a lovely place to spend time with your family, but not enough families are doing so. This is Open Interest.
Let's look at some of the top calls this morning, what analysts are saying on Wall Street. First up, we have JP Morgan. They have upgraded PepsiCo. They cited strong productivity savings. Heard the story yesterday. PepsiCo has an agreement with Elliott. They're going to trim its lineup up to 20%. They plan to cut prices, streamline staff, which I guess means firing people, to help the company's focus. Shares are up 2% after a rally yesterday. Next up, HSBC. They've cut Biogen to a sale. The analysts say that the drug maker faces weaker growth, pressure to cut costs, and sees no clear deals on the horizon to revive momentum. Finally, Blue Owl, that gets an upgrade to a strong buy at Raymond James. The firm says that investors are overstating risks that its private lending funds will face heavy withdrawals next year. They also argue that Blue Owl's strong fees, high margins, 20% plus earnings growth make the stock too cheap. And as Matt just pointed out a moment ago, we're going to be talking to the Blue Owl co-president, Craig Packer. That's at 10:30 a.m. So in just under an hour's time, Matt.
Yeah, and they've had a big run up, 15% from the November low in shares of OBDC. So a lot to talk with Craig Packer about. But we want to get to Cracker Barrel. Shares falling as the company says sales will fall faster than previously expected. It is planning cost cuts to offset those losses and recover from an about face over its logo change. Bloomberg's Red Brown covers the restaurant industry, joins us. This is one that, I mean, for some reason, our control room, you know, the kids in the back row there, have a very high interest in Cracker Barrel. And Paul Sweeney on Bloomberg Radio, it's like his #1 favorite restaurant.
All right.
So what's going on?
Yeah, no, this is a story that keeps on giving. It seems like, you know, the backlash that we all track so closely from when they tried to change their logo and this more streamlined look, removed this character known as Uncle Herschel from the logo. They still seem to be dealing with that fallout. It seems like consumers are still continuing to kind of punish the brand, or maybe they've left and just not come back. So we saw today, yesterday, they lowered their full year sales guidance below what analysts were expecting even. They said this so far, quarter to date, foot traffic is down 11%. So you can really see in that number that like things are just lingering. This backlash is lingering so much, and now the company is kind of in this self-help mode. And
how much of this, though, is like just an excuse? Okay, I'm sure it hurt, right? Because it can't. They got so much national attention. That has to have some sort of repercussions. But we've seen a lot of the sort of food companies, restaurants, fast casual, whatever, that sort of market to kind of a middle type consumer not do well. So is there an issue which is Cracker Barrel in general, logo or no logo drama?
Yeah, I think so. For Cracker Barrel, like they also talked about how they struggled with some of these. They had this phase 1 initiative, and they were trying to like change how they do things back of house. And they said that actually made things a lot more complicated, made things harder to execute. They've had food problems. People don't like the food as much anymore too. So there are actually these things that they've done.
The Big Boy Country Breakfast?
There's things like, I mean, they're bringing things like that back.
Everyone's on weight loss drugs. Maybe you don't want the Big Boy Country.
That is a very good point, Dani. I do think, though, it must be a really different clientele than a Sweet Greens or a Chipotle, right? Cracker Barrel is on the highway. If you're on a trip, or if you're a family with kids that care about like Moana because they sell all those trinkets in the front. So it's not the same as a place you go for lunch in Midtown, right?
Yeah, no, it tends to be like you're saying, a little bit more family oriented, also a little older, which is a segment that we have seen like hold up well in some other restaurants. It might not just be translating into like the regional, more like rural areas that Cracker Barrel is in. I think in general their customer base does skew a little less economically healthy at the moment. So I think that also is weighing in to the results. The company did call out the economic situation. I kind of take that with a grain of salt because of some of these more structural issues that they're having between, you know, the logo change was obviously was a misguided, and then also some of these menu changes that they've done as well seems to not be resonating with the clientele.
Red, thank you so much for joining us. Red Brown, the latest with Cracker Barrel. Coming up on the show, SpaceX's potential IPO could be the breaking point, kicking off a new wave of IPO activity. We're going to look at the sector as a whole coming up next after this break on Bloomberg Open Interest.
Vehicles pitching downrange.
This is Bloomberg Open Interest. Quick check on what's going on in stocks ahead of the Fed decision, and that's a key clause because usually nothing happens ahead of the Fed decision. Right now, we're looking at exactly that. The S&P 500 unched at 68.42. By the way, apparently we've replaced the phrase unch with just dash dash.
Ew. Hate it.
I'm hoping at one point we see an unchanged move on one of these tiles, so I can verify that. NASDAQ 100, the tech stock's down about 0.2%, and you can probably see over my big bald head that NVIDIA is red. It is down about 0.2% as well. Obviously a big heavy weight. Facebook also off right now on, as we get news, not necessarily on the news, that it's coming out with a new AI product, Avocado, that's pay to play instead of the free llama. Oracle is down, Adobe is down. They're coming out with earnings later on. We're watching them closely, but EchoStar is gaining 6% right now, and Rocket Lab is up only a measly 0.2%. But the reason we tell you about these is because Ed Ludlow and team wrote a story yesterday that the SpaceX IPO could value that company at $1.5 trillion and bring in more than $30 billion in proceeds. And that's a key number Dani, because it beats out what we saw from Saudi Aramco as the largest IPO in global history.
Yeah, so it would be just a monster offering. What would that do to overall markets, to overall IPO markets? Bloomberg's Bailey Lipschultz has been writing that it could put $2.9 trillion worth of IPOs in play. He joins us to explain. Hey, Bailey, thank you so much for joining. I mean, is this just a case of like, you get this thing, if it gets digested by markets, animal spirits awaken, everything is fine and dandy for IPOs?
It kind of feels that way. We've been talking to bankers. They're always optimistic. They're paid optimists. But they were optimistic about 1Q before this became more real. And now as it gets more palatable, do we see SpaceX list mid-year? And what does that then mean for the OpenAIs of the world? As you can see on that chart, a lot of valuation of these companies that have been staying private and been able to raise billions upon billions of dollars privately could then be encouraged to go public, something that we've been talking about for years, but it always seemed like maybe next year.
All right, so we're not going to overcome 2021, right?
No, it depends how big it is. Because if we say $200 billion was what was raised aside from SPACs in 2021, and SpaceX raises $50 billion, and Fannie and Freddie raised $25 billion, we're already $75 billion there. We're already on the
valuations, right? But in terms of the number of IPOs, because when I talk to people from the NASDAQ, they're like, okay, you got to take 2021. It's an outlier. So put it to the side when you're looking at IPOs. By the way, look at this. I feel like...
Getting a little smaller.
Great,
I make you feel small. Yeah.
Yeah, so, I mean, can we get back to that kind of craziness, that kind of froth, euphoria?
I don't think so. I think it would be one or two companies doing the heavy lifting. We use that $2.9 trillion number. $1.5 trillion of that is SpaceX. So it would be a number of these companies lifting kind of that tide. But we do have a number of companies looking to go public, and we do have a lot of excitement, whether it's artificial intelligence, whether it's quantum computing, or clean energy.
But that's the thing. Unless you're a big tech company, unless you're SpaceX, unless you have something that really fits with the thematic vibes of this market, can you IPO? Because private equity is still sitting on some real stinkers that they don't want to IPO into the market because they're concerned about what valuations they might get.
Well, we'll get the big test next week, and that is Medline. That's a company that's looking to raise north of $5.25 billion. That'll be potentially at the top end of the range, a $55 billion company, a critical healthcare company owned by a consortium of private equity, Carlyle, H&F, and Blackstone among them. So that'll be a key litmus test. How does that deal get executed? How does that price? How does that trade? Because again, if you stack up a good deal with Medline and you go into a year that maybe people are more optimistic and private equity says, you know, maybe we do cave a little bit on valuation, that does bring at least private equity off the sidelines.
All right, Bailey, thanks very much for joining us. Bloomberg's Bailey Lipschultz there talking to us about the IPO rush that we may see kicked off by the SpaceX story. I have to issue a bit of a surveillance correction here.
Please.
In that, you know, I said Antioch College was now defunct. That's my alma mater. I went to the little liberal arts school in Yellow Springs, Ohio for 4 fantastic years. An alumnus writes in and says, hey, it's back.
Okay.
So Antioch, when I graduated, we were only 900 students, and it had fallen rapidly. By 2007, they just shut down shop. But in 2011, they opened back up again. And
this is so vital for our viewers, so I'm so happy you're issuing. I thought you were going to say, one of the producers pointed out, Matt said that Unscht was gone. There was literally an Unscht behind you as you were doing that big board back
yes,
there. I thought that was going to be your correction.
So,
that the boards do say Unscht.
The boards on TV. I'm talking about the Bloomberg terminal. So if you look at the Bloomberg terminal now, at least according to Paul Sweeney and a number of other really highly regarded sources, Unscht is no longer, I don't know if it's because of Lisa's opposition to the phrase Unscht, but we've replaced it with just 2 dashes. Hopefully we bring it back because it means a lot to a lot of people.
Yes, I do believe that Lisa should have the power, though, to completely change what's shown.
I was just shilling for my alma mater because I have
we check on stocks so we give people something of value before we get to the end of the hour.
Let's look at what's going on. I mean, there's not much of value in terms of a check on stocks either right now because we're waiting for the Fed decision. Our special coverage of that starts at 1:30 today. Coming up in the next hour, Goldman Sachs' David Mericle shares his Fed outlook. Plus, we have Blue Owl's Craig Packer discussing the uphill battle for credit heading into the new year and the CEO of the WTA. We are 30 minutes until the start of trading on this Fed day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger, going a whole lot of nowhere on the S&P 500 after going a whole lot of nowhere yesterday as everyone waits for the Fed decision.
Yeah, divided Fed set to deliver another rate cut today. Of course, the devil is in the details, so keep your algos off until we get the statement.
Good luck on that. Speaking of which, AI fears in the C-suite. Executives across industries rank AI disruption as a top concern. We're going to bring you the details of a wide-ranging Bloomberg survey.
Plus, the view from Blue Owl. Co-president Craig Packer joins us for an exclusive interview as the firm, as private credit as an industry, navigates slightly turbulent times.
We'll get into all of those in about half an hour's time, but first we begin with a caution on Wall Street. Ahead of today's Fed decision, Michael McKee, Bloomberg's international economics and policy correspondent, joins us now from Washington. Mike, even though the market's saying it's a sure thing that we're going to get a cut in this meeting, it still could be a pretty interesting one.
It's going to be a very interesting meeting, and we can start off with some central bank news because, Dani, just 15 minutes ago, the Bank of Canada announced its monetary policy decision. They're on hold, 2.25%. They say inflation's going to rise a little bit because of the end of a sales tax exemption, but overall the economy is pretty resilient, and we're seeing stocks at the TSX up just a little bit right now. But we'll see what kind of reaction we get this afternoon from the Fed because, as you mentioned, there's a lot of division. Since the last meeting when the Fed chair said that there was certainly no guarantee that there would be another cut, we've had a lot of Fed officials come out and take sides. So who ends up where? How many dissents do we get? Dissents have been rare in recent years, but they're picking up. And we'll have to see if we can meet some of these historical markers that we talked about last hour of 3 dissents. We haven't had one since November of 2019, 4 since October of 1992. So maybe we get some information there. But going back to Canada, there is one, at least, economist in the United States, Stephen Stanley of Santander, who thinks maybe they will hold. And a question for reporters to ask the chair, if they don't hold, if they cut, is given the immense amount of data that will be released between this meeting and the next one in late January, if there's no particular urgency today, then the committee would be unusually well served to wait for what promises to be a massive wave of top-tier economic data due out between mid-December and late January, which begs the question, which we might ask him, what's the hurry?
Hey, Mike, I want to go out a little further than January because one of our brilliant producers, Will Shaker, pointed out recently, when you look at the WIRP function on the Bloomberg terminal, world interest rate probability, of course, there's like a 95% chance that they cut today. But beyond that, for January, only a 22% chance. For March, only a 26% chance. For April, only a 20% chance. And then in June, all of a sudden, a 50% chance. Like it shoots up. Is that because then Jerome Powell is gone and like one of the Kevins or Rick is running the Fed?
I think that's the reason for the timing, Matt. The question, of course, is going to be how much more the Fed does the entire year 2026. We'll see that in the dot plot today. There has been a feeling, the Fed in September said they just do one cut in 2026. The market earlier this week had 3 cuts priced in. As of yesterday, 2. So that moves around a lot. But yeah, Jay Powell ends his term as chair at the end of May.
I also want to ask about the view from the Fed on AI, because we're talking about, from a macro perspective, does this boost GDP? Does it add, a point to growth, for example? And does it hit the labor market hard? Howard Marks yesterday warning that it's terrifying for a lot of jobs.
All those things are true, Matt. Nobody really knows the answer right now. What we have is a lot of hardware, and I'm including the software brains in the AI computers in that. But we don't have a lot of applications yet. They're starting to pick up. The question is, how widely is it adopted? How fast is it adopted? And what kind of productivity does it bring? The Fed is keeping a close eye on this. They're doing studies on it, but nobody really knows yet. And it's going to be a while until we actually see any kind of AI effect in the data.
Hey, Mike, thank you so much for the setup. That's Bloomberg's Michael McKee. And don't miss our special coverage of the Fed decision that kicks off at 1:30 p.m. New York time. Joining us now is David Mericle, Goldman Sachs chief U.S. economist. He writes, most investors expect a hawkish cut, though this could be interpreted in a number of ways. It is not realistic to expect the FOMC to box itself in too much by signaling a very strong bias towards a pause in January. David, when it comes to what we're going to get, and thank you for joining us this morning, from the FOMC, are we even going to have a clear message, a clear consensus with just how much division is expected in today's meeting?
I think we will get a clear message that the bar for further cuts, such as a cut in January, is higher than the bar was today. I think we'll get that message from the FOMC statement. I think we'll get that message from Chair Powell's press conference. And I think we'll get that message from the dissents. Both, we expect a couple of dissents to the statement. And I think we'll also see quite a few dissents, soft dissents, we think 5 in the dots, where people write down that the best thing to have done today would have been to just leave the funds rate alone. But that said, I don't think it's ever realistic to pre-commit. And I would say it's less realistic now than ever, because we are 2 employment reports out of date. We're going to get 3 employment reports before the January meeting. And it is quite possible that if the labor market is still actively softening, that cutting in January will be the right thing to do in that circumstance. It's not our baseline expectation, not the Fed's either, I would guess, but I don't think they can close the door to that by giving a signal that's too strong.
David, I wonder what your take is on the effects of AI. Howard Marks, I'm sure you saw, put out a blog post yesterday saying it's terrifying for the jobs market, especially for coders, and for software. But does it add meaningfully to the unemployment rate, do you think, in 2026? Does it add meaningfully to GDP growth in 2026?
I think you've hit on the key issue for the economy and for monetary policy next year. The Fed's been cutting because the labor market has been softening. Now, the premise of our forecast for 2026, and implicitly, I think the Fed's forecast as well, is that GDP growth will pick up somewhat next year as the drag on growth from tariffs gives way to a boost to growth from fiscal policy. We think normally you would expect faster GDP growth to mean faster hiring. We think that will be enough to stabilize the labor market. But I would say that is my greatest point of uncertainty, and I think really the key issue for next year. The reasons I'm worried about that are, first, that in some respects, we're starting from a pretty weak point on the labor market. Job growth outside of healthcare has run negative on average over the last 6 months. And if there's been one key development, even in the absence of official data, during the intermeeting period from the October Fed meeting to today, I would say it's that some signs in alternative data of layoffs are starting to suggest maybe some risk of a problem there as well. So there are reasons to be worried that a pickup in GDP growth, even if we do get that next year, as we're forecasting, might not be enough. We're thinking hard about that. And I would say the other key reason that we're worried, it's not just the weak starting point, it's exactly what you say, the great company focus on finding ways to deploy AI as quickly as possible in order to save on labor costs. That, too, I think would be a new challenge for maintaining full employment. I don't think we see large effects of AI on the labor market data yet. We do see in some very narrow cases, say young computer programmers, signs of an AI effect, but we don't see it more broadly. And so
David, if I can just jump in, because AI and these things are clearly one big effect and where policy goes. But the other big thing is the palace intrigue, the personnel drama, the FT reporting that Trump would soon conduct his final round of interviews, with all signs pointing to Kevin Hassett. But the story was particularly interesting because one idea floated in it was that there have been discussions of a Chair Hassett having a shorter term and then taking Chair Powell's governor seat once that one expires. If we do have something like that, where it's not just a pick at the top that maybe listens to President Trump, but just sheer volatility of personnel in the Fed, not to mention questions around what they decide to do with presidents serving on the Fed board, what does that do to policy?
Sure. I think next year, if the labor market keeps softening, the FOMC is probably going to agree that it's appropriate to keep cutting. But in our baseline, where the labor market stabilizes, there is no longer an urgent problem that needs to be solved. Inflation is gradually moving back toward 2%. That's really an environment where you could cut, but it's probably not essential. And in that sort of environment, I think the views of individual participants on when is it okay from an inflation perspective to say we're past this, we can normalize the funds rate, and on the question of what is a normal or equilibrium or neutral funds rate, that is going to become a larger issue. Now, even aside from politics, I would expect people with identical political views, if you have a committee of 19 people, to have a wide range of views on what the appropriate terminal rate is. And next year, we surely will. I think we will have some people who say, we're there already. After today, 3.5 to 3.75 is the appropriate terminal rate. I think you'll have other people who want to go as low as 2.5 to 2.75%. Our forecast is that they will meet in the middle. You do, of course, need to get majority support of the voters, and having a one or two or three new appointees is not going to be a majority. Our view is they meet in the middle, deliver 2 more cuts, eventually down to 3 to 3.25.
What do you think we see inflation doing next year, David?
I think we'll probably see kind of official inflation, inclusive of tariff effects, getting pretty close to 2% by the end of the year. Our forecast is that by December, we'll be at about 2.2%. Now, we won't have those data until early 2027, of course. And I think in the first half of the year, the numbers are going to fall at a slower pace. If you're willing to say, we know that a lot of this is a one-time price level effect from tariffs. After all, we have about 4 different estimates of tariff effects, and they're all in the same ballpark. Then you say, as we would say, as Chair Powell would say, well, we're officially at 2.8. But if you think tariffs are 0.5 point or more of that, then maybe we're already actually in the low 2s. Not everyone looks at it that way on the FOMC. So I think the real question is, when are the people who have been a little bit more concerned about inflation going to become comfortable that it's okay to cut a little further, that this problem is behind us?
Well, and those tariff levels can change at a whim, right? I mean, it doesn't seem like they're set in stone.
Yeah, we're expecting much less, actually very little, in the way of incremental tariff effects next year, which would mean that by the end of the year, whichever perspective you take, whether you look at the official data or whether you look at inflation excluding tariff effects, you'd be more or less on the same page.
All right, David, thank you so much. The countdown's on, less than 4 hours until the Fed decision. David Mericle of Goldman Sachs. A quick check on markets. Ahead of that Fed decision, you are still looking at an S&P that's little change, a NASDAQ that is trading lower, not getting any support from yields, which are moving lower by 2 basis points this morning for your 10-year yield. That is still some pretty lofty levels. We were at around 4% only a month ago. We're at 4.1683 with global bond yields moving higher, influencing what's happening here in the U.S. Maybe the Bank of Canada helping in that. They didn't raise rates, but still talking about elevated inflation, Matt.
All right, let's get a look at some of the single stock stories that we're following for you this morning. We're keeping an eye, obviously, on Oracle. The company reports results after the bell, and there are concerns about, well, if you look at the CDS chart, it just doubles, although it's still at a very low level.
Yes, that is true, but it is growing. By the way, speaking of AI concerns, Meta's Mark Zuckerberg, according to Bloomberg sources, has directed his team to pivot away from open source AI. They're developing a new model. It's codenamed Avocado, and it may charge users for access.
And EchoStar and Rocket Lab are climbing after Bloomberg learned SpaceX is moving ahead with plans to launch what could be the biggest IPO in world history.
Coming up, disruption risk is putting AI at the top of the agenda for C-suites. That's according to a new Bloomberg Intelligence survey. We're going to discuss that next. You're watching Bloomberg TV.
Getting out of high interest, look what's making headlines around the world. The Information reports that Deepseek has been building its next AI model using thousands of NVIDIA Blackwell chips smuggled into China. Dealers reportedly routed the hardware through Southeast Asian data centers, dismantled servers, and shipped the pieces into China under false declarations. The operation shows how difficult U.S. export bans are to enforce. I believe we got an NVIDIA response to that report in that they have no knowledge. NVIDIA says, we haven't seen any substantiation or received tips of phantom data centers constructed to deceive us or our OEM partners, then deconstructed, smuggled, and restructured somewhere else. While such smuggling seems far-fetched, we pursue any tip that we receive. Now, the University of Utah is diving headfirst into private equity, launching Utah Brands and Entertainment, a first-ever private equity partnership in college sports. The school hopes the deal with Otro Capital can unlock nearly $500 million by treating sponsorships, ticketing, and licensing like big league business. Utah insists it's not selling off sports, just bringing Wall Street swagger to campus in order to stay competitive. We're going to talk more about this with our sports reporter, Randall Williams, as well as Marina Storti, WTA Ventures CEO, later this hour, because I think this could be the beginning of a sea change in college football.
Yeah.
A new Bloomberg Intelligence survey says robots aren't replacing bankers just yet. In fact, 2/3 of financial firms expect headcount to rise as they roll out AI, with more than 70% predicting higher operating costs over the next 3 years. Analysts say this early phase is about building AI capabilities, not cutting staff, although real efficiency gains may show up not until after 2027.
By the way, Matt, along these same lines, Bloomberg Intelligence did a fantastic survey, a really thorough one, about the disruption of AI risk and how C-suites are thinking about this. 6 months to execute. Over 600 C-suite executives across 9 industries participated in this survey. Let's hear more about it with our senior tech analyst, Anurag Rana. Anurag, first of all, fantastic job for you and the team. I know this was a huge undertaking. And one of the more interesting things is, yeah, everybody is spending on this, but the narrative that the C-suite tends to give is like, we're finding really good productivity benefits, and that's why you're spending. You're kind of painting a different picture, that it's anxiety and it's fear that's fueling the spend.
Yeah, I mean, one of the things that we were surprised about was the panic mode that they're in terms of the disruption risk this thing can cause. And it's not so much just in the software industry that Matt talked about just, a few minutes ago, but it's also in industrials, in autos, in pharmaceuticals. So there is a widespread fear that the main business people are in that can get disrupted, and they are adding more capabilities across all horizontal lines. It's not just as if they are just focused on, software coding, for example, but they are adding those things in accounts payable, accounts receivables, throughout the ecosystem. And that, I think, is the single biggest important thing for us. The other thing that stood out to us was when we asked all these executives, I says, what is it that's the biggest roadblock for you right now? And the answer was the availability of AI infrastructure. So that gave us a little bit of hope that all the money that's being spent by the likes of, Microsoft and Amazon and Google may not be going to waste, because we see that in their backlog, but we see this with leading indicators that people are looking to deploy more and more products right now.
As I was saying a little bit earlier, I was just hanging out in an informal beer type of gathering with a bunch of lawyers and consultants and investment bankers, and they all said the same thing, that they don't really need their freshman class. Like, maybe save 2 or 3 people. AI can do pretty much everything else that this younger generation would normally do in a first year. However, the biggest concern is the funnel, right? They need someone to be a first year so that they can later have 5-year and 10-year experienced, more senior staff. How do these industries, aside from software, which could just completely go away, how do they cope with it?
I think the biggest and the most important factor is you have to look at each industry and subsector and what kind of pyramid they have. So if you have a senior researcher, for example, that has, let's say, 5 juniors, that's no longer going to be the case. You may see the ratio between, that 1:5 may change to 1:3 or 1:2, but you do need those people, freshman people, to come in, because otherwise who's going to carry it on going forward? So I think there is going to be a lot of reshifting of the pyramids. Now, one of the things that we have observed, even in our financial analysis, is some of the tech companies are already showcasing that. We've seen this with Microsoft. We've seen this with ServiceNow, that the rate of employee growth has slowed down in the last 3 years compared to how much the revenue is going up, which is leading to a higher revenue per employee. Now, that, I think, is partially driven by AI, partially driven by cost savings or the need to cut cost, and partially driven by the overhiring everybody did during COVID time. So there are multiple factors, but I think the rescaling of the pyramid is one of the most important factors. I think it's not talked about a lot.
Anurag, really quickly, because we're almost out of time, I don't want to just like leave to the side Matt's comments about software and tech services, because you surveyed executives from that sector. I mean, are they on full-on panic? How are they feeling?
No, they are adding, AI quite a bit. And in fact, that was the only one sector that did predict that they could see some headcount reduction over the next 3 years. The others, not so much.
All right, that's fascinating because it aligns perfectly with Howard Marks' piece yesterday. And by the way, Anurag, congratulations on this work. I definitely encourage any terminal users to go ahead and type BIGO, and you'll see this report in the spotlight in the upper right-hand corner of your screen. Anurag Rana there on Bloomberg Intelligence after a really thorough piece of research that took months and months and involved hundreds and hundreds of sources. Still ahead, we're going to get the view from Blue Owl co-president Craig Packer. He joins us around the table to discuss his outlook for the year ahead. This is Bloomberg Open Interest. Going to check on markets right now. You can see that the S&P is unchanged, and we do have a Fed decision later on today, so it's unlikely to move too much ahead of a Fed decision, maybe after. NASDAQ is down about 0.2%. That aligns pretty much exactly with what we're seeing on NVIDIA, the NVIDIA trade as well. The 10-year right now at 416.83, so coming down a couple of basis points, but we're watching it very closely. Coming up, an exclusive interview with Blue Owl co-president Craig Packer following a volatile couple of months for private credit.
It's been a volatile couple months for Blue Owl Capital, at least the shares itself, not the firm itself. It caught itself in the middle of Wall Street's private credit fears. The company scrapped plans to merge two of its private credit funds back in mid-November after concerns over potential investor losses sent the shares tumbling. But to be fair, not only have they risen, they are now, at least for the BDC, trading back at the levels that it was at before the fall. You're looking at the firm shares there of Blue Owl. Joining us now, I'm pleased to say, is Craig Packer, Blue Owl co-president and head of credit. So hopefully things are a little bit more calm for you at this moment, Craig. But just looking back in that incident, because I've heard you describe before that this merger was something you had planned on for a while. It wasn't a last-minute decision.
Sure.
But if you could do it all over again, do you just regret the timing of the announcement and of the merger?
Well, as you noted, we're pleased to see the stocks come back. I don't really regret it because I think we were trying to do the right thing for the shareholders. I think there was a lot of confusion. This is a fund that, relatively small fund for us, but we'd raised it about 9 years ago. There was always a plan to provide a transaction where investors could get liquidity. We thought this was the right plan to merge it into our publicly traded fund. When we announced it, we still felt that way. After the announcement, the stocks traded down. It caused a lot of confusion, and we thought it was the best move to pull that transaction. We're going to work with our board, figure out the best plan to make good on what we've told investors in providing an ultimate exit. I think it'd be disingenuous for me to say, of course, we didn't anticipate the stocks would trade down. We certainly didn't anticipate it would create all this confusion. But I think there was a lot of obvious logic to it.
So you still want to merge the two? Or are you reassessing that completely too?
We're not going to merge the two back together. I think that it's like to say keep all options on the table, but that's not a very high likelihood outcome. But there's a lot of good options. I think this got more attention than it's needed. We have a time period measured in years to figure out what to do with this fund. This fund is performing well. It's got plenty of liquidity. There's a lot of flexibility, and we'll figure out the right path.
Craig, as I understand it, the concern was that OBDC, the publicly traded asset, was trading at like a 20% discount to NAV. I just did Ask B Go on my Bloomberg terminal, and it says it's now 10%. Yeah. So that discount to NAV has collapsed. Yeah. What caused that then? And still, what's keeping it under its net asset value?
Sure. In terms of what caused it then, The performance of the fund has been very good. It's been one of the best performers in the sector. Credit performance is good. The dividend is good.
It's up
Returns
15% from its low in terms of the price.
I think sometimes public BDCs, there can be some confusion around them. People see the headlines, they get confused. It can create short-term technical selling pressure. People don't appreciate the stability of BDC earnings. Read about one credit default somewhere in the world and people extrapolate. And we're just in one of those moments where people were responding to the headlines. As you said, it's up 10%. I was very public. I bought shares, at 80 cents on the dollar, made 10% in 10 days, 2 weeks. There can be times where BDCs just don't trade with their fundamentals. Why is it not higher? Some of our peers are closer to book value, and I think over time we'll head back in that direction.
Craig, though, isn't this idea that people looked at this narrative and they were confused, they didn't understand, they couldn't differentiate some of the concerns about Tricolor and First Brands, you weren't involved in them at all, and all of that kind of thing. Doesn't all of that argue that maybe that this is a product that retail's not ready for, that there's still confusion? And we see in other industries like tobacco, for example, it got highly regulated because courts there said it wasn't enough that experts understand this. If there are people out there who don't understand this, then this product should have more eyes and attention and maybe regulation around it.
Respectfully, I couldn't disagree more. We continue to see strong interest in the products from the investors. We just announced record inflows into our retail funds at Blue Owl, the highest in the history of the firm. We continue to see monthly inflows into our credit funds. There's a lot of interest. I think these products fit the long-term oriented retail investor who's interested in a very consistent income stream and not trying to trade on short-term views on rates. It suits them really well. They take that approach. I think it's underappreciated how thoughtful retail investors view this space. That's what we are experiencing. When you get out into the broader world, people ask these questions. In our world, we're seeing strong reception. When we talk to clients throughout this, they're very encouraging conversations. They're not confused, but they see the headlines. They want to make sure they're not missing something. We have those conversations, and they're reassured. I actually think these products are a really nice alternative. Would encourage any investor to put most of their assets in any investment. But I think in moderation, as part of a portfolio with a long-term dividend orientation, I think they work quite well.
I recently saw, I wonder if it's about the exposure that you have, Blue Owl, as opposed to concerns in general about cockroaches. We had a great story by Paula Seligson and Caleb Mutua about big Wall Street banks looking at significant risk transfers to kind of diversify away the risk that they have in data center investment, because there have been hundreds and hundreds of billions of dollars put into that. And you guys also are exposed with the Meta deal, for one, but with others as well. What do you think about that? The fact that big banks are using SRTs to diversify away? Are you worried about how much risk do you have, how much exposure do you have to data centers?
So when we invest in data centers, we do it in our real assets business, not in our credit business. Our real assets business has been investing in data centers for many years, pre the AI growth. The cloud was a big driver of data center usage. We actually think it continues to be a really attractive space. The way we play data centers is we're working with some of the strongest, most financially sound tech companies in the world that really want this capacity and work with us in very carefully constructed financial partnerships where essentially we're using our financing capability and creating bond-like returns. We're a financing source for them. We are not making an ultimate bet. We want our partners to do well, of course, but they're really playing for the capacity that they see that this is critical for their businesses. As you said, we continue to see strong demand there. We have the capacity. One of the funds that we just closed on in the fourth quarter was a fund targeting digital infrastructure. We continue to see a lot of investor interest. These transactions we think are very attractive, risk-adjusted returns. And I think if the banks are using SRTs and other technology to manage their balance sheet, that sounds like a very smart way for banks to manage their exposure to any one sector. Our funds are designed in this space to take this type of exposure. We size it appropriately for the capital that we have. I'm sure that the banks are performing similar calculations for how their balance sheet be used. I think those things can be very consistent.
By the way, one of those designs, when I was talking to Sri Natarajan, whom I'm sure you know about this, he said, look, if the Meta deal collapses, Blue Owl will be made whole. So you have worked clauses in to protect yourselves. Can you explain that? And also, how big is your total exposure?
So again, not to beg off of it, this is really in our real assets business. I run our credit business.
Okay.
But you're absolutely right, though, and I'm glad that you're asking this because I think people just see a headline or two, and candidly, you get a very superficial response. We've been doing this for many years. How you structure the deals with a fantastic counterparty like Meta, it's very important. We structure it carefully, and yes, you're right. We guarantee ourselves a certain return profile for the use of our capital over a 15-year period of time that we think is very downside protected and delivers great returns for our investors. We do this in the Meta deal, and we do this in all the other deals that we've structured in the space.
Well, all this stuff is changing so quickly, and I think that's part of the thing, right? People have a really hard time wrapping their heads around the opportunity and just the dollar sizes behind it. The other thing that also means is changing really quickly is software. And here you're an expert. You have singular funds dedicated to software too. I personally have heard rumblings out there that we're about to see some really big defaults in the market when it comes to software companies, not Blue Owl, to be abundantly clear. But how much of this is a sector that it's so hard to know how it's going to look in 3 years' time? Because 3 years ago, we didn't even really see the AI disruption that was coming to it.
Yeah. I'm going to tease you a little bit. I'm hearing rumblings. We'll see. But that's not what we're seeing. We're seeing our software part of our book continue to be the strongest performer, in our portfolios. Since the advent of ChatGPT, our software businesses have experienced 40-50% growth in EBITDA. A good software business is embedded in its customers, and it's using AI to make their business better and more efficient. Of course, AI is a transformational change. There may be losers out there, but we're not seeing that. We're not seeing that type of existential risk. You have to be experienced in this space. You have to be able to differentiate a good business from a bad. I think we do a really good job about that. And I think software is going to continue to be just part of the playbook of AI is going to continue to be part of a well-run software company's playbook. That's what we're seeing. We're not seeing any impact in the short term. If anything, these companies continue to prosper.
Well, we hear something similar when we talk to other big credit players from Apollo to Goldman Sachs. They say, look, we have a team that knows what it's doing. And I trust them, and I trust you to that extent as well. But I wonder just your take on the broader software industry, because it does look like you're going to be seeing pricing compression, seat reduction, AI native competition for a lot of these companies out there that, again, you're not necessarily invested in, but it will be a sea change, right? Howard Marks yesterday was writing about the fact that employees should be terrified.
Yeah. Look, I think it's important not to just talk about our business. What I'm describing, I think, is large enterprise software businesses backed by sophisticated private equity firms, not really small businesses that could wake up. If you look, think about
but I'm looking at Salesforce is trading at the cheapest valuations since I can remember.
Or Klarna deciding to forego some of their,
There's no doubt that there are going to be changes. What we focus on is enterprise software. This is software that's embedded in a company's operations. They use it to pay their suppliers, schedule their employees, collect receivables. It's inexpensive. It's hard to rip out. There's not much economic incentive to rip it out. It's not just delivering data with a query. It's how companies operate. Candidly, I was thinking on the way in, what a great Bloomberg, right? Imagine how well Bloomberg has done all these years. You might have said the same thing about Bloomberg. Why does it still exist? It exists because it's really powerful for its customers, and it's really disruptive for customers to rip out. I think really good software businesses have some of the very same characteristics.
Craig, I'd love to just end on the private credit industry as a whole, because it's seen just really, really rapid growth. A lot of maturity coming in. Blue Owl is another one of these big firms that have arisen and done some very interesting deals. We've been talking about them. But at the same time, I was talking with someone yesterday who said that fundraising for the industry as a whole is actually set to drop in 2025, which surprised me. But it talks to this idea of people being more picky with what managers they want to be in. The most recent numbers I'm looking at, anywhere between 1,000 to 1,500 private credit funds exist out there. Yeah. Is there going to be just some real change ahead and some real consolidation in the industry?
I think that the clients, the fundraising environment was very good. A lot of people rushed in, and you had a lot of smaller players that were able to raise a small amount of capital with a small team. And at this point, they probably don't have the same ability to raise capital. I think the industry will continue to migrate to the market leaders. We happen to be one of them. We're not the only one. We continue to see a lot of inflows. Clients are going to concentrate their investing with the larger players. Larger players can invest in team resources, portfolio management, all the things that are important. And borrowers want to borrow from the bigger firms. So we think the trends will continue to be strong. You may see ebbs and flows for a quarter or two, but we're going to have a record year in credit fundraising this year. I'm not in the business of predictions, but it wouldn't surprise me if we have a record again next year, because the asset class continues to deliver and the asset class continues to get greater penetration in the wealth channel and in the institutional channel.
Well, it has been fascinating to watch, and Blue Owl is no doubt a flag bearer, really, for private credit. Craig, thank you so much for coming on and joining us. Craig Packer there of Blue Owl. Now, coming up, the WTA women's tennis lands the largest sponsorship in women's sports history. Marina Storti, the WTA Ventures CEO, joins us to talk about that next. This is Bloomberg Open Interest. A landmark deal in the world of college football. The University of Utah is teaming up with private equity firm Otro Capital. The school hopes the deal can unlock nearly $500 million in revenue from ticketing, concessions, and sponsorship, and it will be a for-profit venture. Joining us now to talk about it is Bloomberg sports reporter Randall Williams. And Randall, Joe Chiaffi in the control room showed me this story yesterday, and I have not been able to stop thinking about it since. Because imagine if private equity starts to buy into college football teams, that matter, like The Ohio State University or Notre Dame. Is that the future we're looking at?
I think private equity and college sports have been flirting around for the last couple of years, and this is the first deal that is signed, sealed, and delivered. Of course, there is the deal with the Big Ten that had been spoken about, and that's been put on hold, but this one is huge. And I think that when you're looking at the landscape of college sports right now, of course, we have the college football playoff going on, and teams are missing out on that. And so when you see that and you're trying to figure out ways...
Teams like Notre Dame?
They decided not to themselves.
They did not make it, and then they decided they're not going to play a bowl game. Now, Notre Dame is not going to have any issues with revenue, but Utah, which isn't in one of these big conferences like the Big Ten or the SEC, they might. So this is why we're getting this deal.
It's a classic PE play. Take something that's inefficient, bring efficiencies to it. But if I think about, for example, the Premier League in Europe and the passion around it, I feel like the closest thing we have to that is college sports. People care so deeply about it. And every time you see, there are owners of Premier League teams that the fans hate and sometimes make life very, very hard for them. Could there not be a real big backlash to private equity coming into people's pride and joy, like The Ohio State University?
So. Dude, I have to say, this reminds me of when Roman Abramovich bought Chelsea, because that kicked off a sea of, multiple £100 million investment in soccer teams. And
I do think that there could be backlash if the investment does not go well. So what they're creating is a holding company. And one of the things that is very interesting to me is that it says sports and entertainment. When you think of sports and entertainment, you're thinking of Kroenke, or you're thinking of Jerry Jones's holding company, all of these different professional teams that have these other departments that also work to bring together concerts and things like that. But this is a holding company at a college. And so that is unique in itself. And I think it'll be really interesting to see how it plays out over the next couple of years. Because what if in 5 years from now, they don't make the college football playoff and they don't make it to, let's say, the Final Four or the Elite Eight? What are going to be the avenues of profit if you're not winning?
But what if schools like Utah are winning national championships because they're able to pay their players enough. Remember, NIL is now just money from boosters. But if private equity can pay players, they're going to get the best players there are.
It's true. It's true. And a school like Utah will need this. But you mentioned Ohio State and Notre Dame. These are schools that, in essence, should be there just about every year without those private equity dollars. Now, if Utah starts competing on a level at Ohio State and Notre Dame is, then I have no doubt that there will be an investor at Ohio State's door. And there probably have already been multiple people knocking at some of these larger schools who want to make deals.
It could be anybody. Even Michigan could get a good football team.
Can you tell he's from Columbus?
I can't wait to hear how this evolves. Randall, thank you very much.
Thank you very much.
Bloomberg's Randall Williams. From football fields to the tennis courts, the WTA just moments ago announcing a new premier partnership deal between the WTA Tour and Mercedes-Benz. It's said to be the largest sponsorship in women's sports history. Marina Storti, WTA Ventures CEO, joins us now. Marina, thank you so much for joining. Congratulations on this record deal for women's tennis. So your partner before this was Hologic. And I'm going to be honest, I mean, it's not a company I or anybody else probably interacts with on a daily basis. Mercedes, it's got cachet, it's got a luxury and storied history behind it. Just beyond those vibes, real world on the ground, what does it mean to have this partnership?
Well, firstly, thanks for having me today. Look, I want to say this is a real landmark partnership for the WTA. It is the largest in our history. And for us to welcome Mercedes-Benz as the premier partner of the WTA Tour, you know, a brand that is trusted and admired all over the world, a brand that stands for excellence, innovation, and really one that has a shared belief in the future of women's tennis. It's a pivotal moment, and we are incredibly proud.
I first want to say that if you're a doctor or a nurse, you interact with Hologic on a regular
my
basis.
bad. True, yes.
And secondly, you know, I grew up going to Mercedes has the big tennis tournament in Stuttgart every year, the Weissenhof. And I always would go to Filderstadt to watch the women play. I think Porsche was behind that. These are great events. They're not grand slams. And this is the kind of thing that I guess you want to see more people appreciating and going to. How much bigger do you think this could make tournaments like that on the map?
Yeah, I think what's great about Mercedes-Benz, firstly, they're making a long-term commitment, and that's really important. But also their presence will be across, like you say, all of the categories of the WTA Tour, from the smaller events, the WTA 250s, to the kind of crown jewel of the tour, the WTA 1000. And really what we'll see is, you know, it will elevate the experience across the tour and create opportunities along the pathway.
Marina, and of course, WTA Ventures exists. We were just talking about private equity in college football. This is also a private equity child as well, with CVC coming into the WTA. It is a moment where people are questioning the business of sports because for tennis, it has so much money-making potential, but it is so incredibly fragmented. Just looking at the future of WTA, be it partnerships or otherwise, in order to grow, get the revenue you deserve for media rights, how much is consolidation necessarily part of the story and things like merging with the ATP?
Well, what I would say that this partnership is testament to just the extraordinary commercial momentum behind women's tennis and the global appeal of the WTA Tour. We have an incredible history, but also we have a very brilliant future. As I said, you know, we announced it last year. We have a kind of a goal to triple the value of the WTA, to triple commercial revenue by 2029. And a partnership like this, along with all of the other partnerships that we've been able to sign this year, really put us on track, firmly on track towards that goal. We do believe that there's potential certainly for further alignment in tennis, but we think whatever happens, we have a very, very strong future ahead.
How important is in tennis having a huge star? Like, I think of women's tennis and I think of Serena Williams, right? Can you get her to come back?
Well, of course, it would be amazing for Serena to come back, but I think she said a few days ago, I read that she doesn't have plans. At least that's what she said publicly. But I would say that we have an incredible array of athletes on the WTA Tour. We have amazing diversity. We have, the top 7 athletes, highest paid athletes in the world. They are some of the most admired, most recognized athletes. They're global influencers. They're incredible fan bases. And what I really love about the WTA Tour is just the sheer diversity that our athletes bring. They're role models. They're diverse role models. They represent so many different nationalities, different backgrounds, different age groups. And I think that's probably our biggest strength, I would say.
And I personally, and I can speak for Matt here, love watching it too. Hey, Marina, just super quickly, we have less than a minute, but there have been rumors maybe the Saudis circling around, the Grand Slams, trying to put together their own sort of venture that takes up women's tennis. Is this a moment of kind of like existential concern for the sport?
Look, right now, the moment that I'm most excited about is this moment right now. We are here celebrating, the largest partnership in the WTA's history. Is a moment that really shows how far we've come, but also the potential that we have ahead. Is one that we are celebrating today. And as I said, I think we have a brilliant future, and we're incredibly excited.
It is exciting, and if you get to pick your own Mercedes, can I recommend an AMG SL63E Performance, because that's the one that I would choose. Marina Storti there, the CEO of WTA Ventures, on their partnership now with Mercedes-Benz. Coming up, countdown to the Fed. Don't miss our special coverage kicking off at 1:30.